Capital Market lecture series. Today we will discuss about the capital market instruments and what are the instruments of capital market, and we have learned what is the meaning of capital market, what are the functions of capital market, what are the basic differences between the capital market and money market. Today we want to discuss about the capital market instruments. What are the instruments available in the capital market? Usually instruments available in the capital market can be classified into three categories. They are pure instruments, hybrid instruments, and derivative instruments. Pure instruments can be, or examples of pure instruments are equity shares, preference shares, debentures, and bonds. And hybrid instruments are created by combining the features of either of these pure instruments like equity, preference, bonds, etc. are called hybrid instruments. They will be showing the characteristics of the combinations of any of the pure instruments. And examples of hybrid instruments are convertible preference shares, non-convertible debentures, etc. are some of the examples of hybrid instrument. And third type of instruments are the derivative instruments, and these derivative instruments are they derive its values from the financial instruments or the variables. Some examples are futures, options, etc. These are the different types of the instruments available in the capital market. They are pure instruments like equity shares, preference shares, debentures, and bonds. Hybrid shares, a combinations of the pure share and derivative shares or derivative instruments like futures, options, etc. These are the various types of instruments available in the capital market. And the capital market instruments can be classified on the basis of the corporate securities also. On the basis of the corporate securities, the capital instruments are divided into two. They are ownership securities and creditship securities. The ownership securities are further divided into ordinary equity shares, preference shares, and deferred shares. And creditship securities are the debentures comes under the creditorship securities. And there exists another category of classifications like owned instruments, owned or borrowed instruments, ADR, GDRs, and derivatives. Here owned instruments are the pure instruments like preference shares, equity shares, etc. Owned or borrowed comes under this. Owned or borrowed can be divided into two: secured and unsecured. Secured instrument is debenture, and unsecured are bonds and public deposits. And in addition to this owned and borrowed, there are instruments like ADR, GDR, derivatives, etc. These are another type of classification of the capital market instruments. Then first type is the pure instruments, and in that we can have equity shares, preference shares, deferred shares, etc. And we'll see what are the meanings or what are the features of these shares. Then equity shares are generally large part of the total shares issued by a company, and these are also known as the common shares, ordinary shares, risk shares, etc. Here one of the important feature of equity share is that this type of share does not enjoy any preferential right. Here the equity shares do not have any preferential. There may be some preferences like the getting a fixed rate of dividends and the returns of the asset, etc. But in the case of equity shares, there won't be no such preferential right. And the preferential rights like the rate of discount is not fixed, and it varies according to the profits. That is the rate of discount. Rate of discount is the return for the shares we have purchased from a company, and the discount varies according to the profits. And the right to control over the the equity shareholders have the right to control over the management of the company, and they get dividends after paying the dividends to the preference shares only. But there exists another category of shareholders, namely preference shareholders, and the equity shareholders usually gets the dividends after paying dividends to the preference shares. The equity shareholders usually takes more risk than the preference shares. Third one, the equity shareholder cannot be redeemed during the lifetime of the company. These are some of the features of the equity shares. The features or ordinary equity shares are ordinary shares or common shares or the risk shares, and they have no preferential right. The rate of discount is not fixed, varies according to rate of discount, varies according to profits. They have right to control over the management. That is why they have voting power. They get dividends only after paying dividends to the preference shareholders. They have more risk and they cannot redeem the equity shares during the lifetime of the company. They can redeem it if the company is winding up, or if the company winds up, then only the equity shareholders can redeem their shares. This type of shares are known as the equity. Features of the equity shares are they remains permanently with the company. That is, they cannot redeem during the lifetime of the company. They have equity shareholders have voting right. They cannot or they won't get a fixed rate of dividends, and their dividends depends upon the surplus funds, etc. These are some of the features of the equity shares. That is, it remains permanently with the company. They have voting right, but the dividends are not fixed. But the dividends and their dividends depends upon the surplus. What are the advantages of equity shares? From the part of the company has no obligation of fixed dividends, and a company should not be bothered about the payment of the dividends. In the case of the equity shares, can issue without adding additional asset. This equity shares can be issued without creating any more assets, and it therefore it is a permanent source of income to the company. Permanent source of income in the sense that these equity shares are issued without adding more assets to the company, or with the existing assets of the company. Equity shareholders are the real owners of the company. They are the real owners and they have the voting right during the profit. If the company has profit, or if the company is earning profit, the equity shareholders will be the gainers. They will get the dividends as well as they will get the appreciation of the value. These are some of the important features of the equity shares. Then, or advantages of the equity shares: there is no obligations from the part of the company, as the dividends are not fixed. It can be issued without adding some more assets. This is permanent source of income to the company, and they are the real owners. They have the right vote to right, and if the company is earning profits, then the equity shareholders are the real gainers, and they will get the dividends as well as the appreciation of value. Then disadvantages of the equity shares: trading on equity cannot be done if equity shares are only issued. If equity shares are the only shares, then trading on equity cannot be that much profitable. And another one is it cannot be redeemed, and it cannot be redeemed in the sense there is then there will be a danger of overcapitalization. Then third one is that they can put obstacles on the management, since they have voting right. And the next one is fixed income group have no attraction, as it is not or they are not assuring any fixed return or fixed dividends to the equity shareholders. These are some of the disadvantages of the equity shareholders. And the second type of capital market instrument is the deferred shares. These deferred shares are issued to the promoters or founders for the services rendered to the company. These shares are issued to the promoters or founders for services rendered to the company. This, therefore, it is also known as founders share, because they were normally issued to the founders. Since it is issued to the founders of the company or institutions, then it is also known as founders share. Uh, these shares rank last as far as payments of dividends and return of capital is concerned. They will get the dividends as well as the return after settling all the payments of dividends and returns to all other shares. Small denominations, they have voting right, and it will increase the efficiency and the economy in management, in the sense that they will get dividends and return after paying dividends and returns to all other shareholders. If there is surplus fund, then only they will get the dividends and the returns. Therefore, it will, these types of the shares will enhance efficiency and economy in management, and they have specific management over the company. And as per the Companies Act 1956, no public limited companies or subsidiaries of public limited companies cannot issue deferred shares. And as per the Companies Act 1956, deferred shares are not, or a company cannot issue deferred shares. And next one is the preference shares. Preference shares are those shares which have preferential rights for the payment of dividends during the lifetime of the company, and for the return of capital at the time of winding up. That is, they will get some preferences. Preferences are in the form of getting dividends as well as getting a return of capital at the time of winding up. Shareholders have a preferential right over the equity shareholders. They have preference right to get the dividends at a fixed rate as well as the repayment of capital if the company winds up. Then advantages of preference shares. Some of the advantages of preference shares are, they are long-term capital. Our preference share provides a long-term capital for the company. Redeemable preference shares have added advantages of repayment of capital. Whenever there are surplus funds with the company, they can redeem the shares. Third feature is that it is considered, or it is a part of the company's net worth, and therefore it enhances or it increases the credit worthiness of the company. It earns a fixed rate of dividends, and they do not carry the voting right, no interference. Therefore, they have no control over the management of the company. Then disadvantages of the preference share is an expensive source of finance as compared to the debt, because because generally the investors expect a higher rate of dividends on the preference shares as compared to the rate of interest on the debentures. Therefore, it is an expensive source of finance to the company, since they will get the fixed rate of shares or dividends. They do not enjoy the voting right. This is the second disadvantage. The third disadvantage is that the rate of dividends on preference share is usually lower compared to the equity shareholders or equity share dividends, and market price of preference shares fluctuates much more than that of debentures. These are some of the important disadvantages of the preference shares. The disadvantage, it is expensive, no voting right, rate of dividends are lower than the equity shares, more fluctuations, etc. These are some of the disadvantages of preference shares. Now we want to see what are the different types of preference shares. First one is cumulative preference shares. Cumulative preference shares are when unpaid dividends on preference shares are treated as arrears and are carried forward to subsequent years. Then such preference shares are known as cumulative shares. Then unpaid dividends on preference shares are treated as arrear and are carried forward to subsequent years. That is, it is a cumulative, or these are the cumulative in nature. That is, the unpaid preference shares arrears are accumulated over the years. Second one is non-cumulative preference shares. In the first one, we can cumulate over the year. The second case, non-cumulative preference shares are those type of preference shares which right to get have fixed rate of dividends out of profits of the current years only. They do not carry the right to receive arrears of dividends. That means non-cumulative preference shares will get the dividends at a fixed rate on the current or in the current years itself. They have no, or it won't be carried out there, or it cannot be considered as an arrear, or they cannot carry forward in the form of arrear. Third one is redeemable preference shares. These preference shares are which can be redeemed or repaid after the expiry of a fixed period are known as redeemable preference shares. These redeemable preference shares can be redeemed after a or repaid after a fixed period. Then next category is non-redeemable, which cannot be redeemed during the lifetime of the company, are known as the non-redeemable preference shares. Here we cannot redeem the shares during the lifetime of the company. The amount of such shares are paid at the time of liquidation of the company. The next one is participating preference shares. Participating preference shares have the right to participate in any surplus profits of the company after paying the equity shareholders in addition to a fixed rate of dividend, are called as participatory preference shares. They have the right to participate in any surplus profits of the company after paying to the equity shareholders. That is, after making the payments or dividends to the equity shareholders, they have the right over the surplus profits. Non-participating preference shares are which have no right to participate on the surplus profits of the company. In this case, the shareholders have no right to participate in the surplus profits of the company. Then next one is convertible preference shares. And convertible preference shares can be converted into equity shares at the options of the holders. That is, here we can convert the preference shares into equity shares after considering the preferences of the shareholders or options of the shareholders, and it has to fulfill certain conditions or according to terms and conditions of their issue. Non-convertible preference shares are the next category, and non-convertible preference shares are which cannot be convertible into equity shares are called non-convertible preference shares. These are the different types of preference shares. Then here the first one is cumulative, that is dividends can be accumulated over the years. The dividends as well as the arrears can be accumulated. If that arrear cannot be accumulated over the years, then it is known as non-cumulative. Redeemable shares are those types of preference which the right to get the fixed rate of dividends out of the profits, which can be redeemed or repaid after the expiry of the fixed period. Non-redeemable preference shares that it can be redeemed after they cannot be redeemed during the lifetime of the company. Participating means they can participate in sharing the surplus profit. Non-participating preference shares means they cannot participate in surplus profit sharing. Convertible preferences means they can be converted into equity shares. The non-convertible preference shares are which cannot be converted into equity shares. The next section is on the comparison between preference shares and equity shares. In the case of the preference shares, the rate of dividend is fixed, whereas in the case of equity shares, the rate of dividend is not fixed. and it depends, or it varies, and it depends upon the profit. This is the first difference between the preference shares and the equity shares, that the preference, in the case of the preference shares, dividends are fixed, whereas in the case of the equity shares, the shares are not fixed, or the dividends are not fixed, and it depends upon the profit. Second difference is that in the case of preference shares, the arrears of the dividends can be get accumulated, but in the case of the equity shares, no such accumulations will be possible. And third difference is with respect to the preferential rights. The preference shareholders have their preferential rights of getting dividends prior to the equity shareholders, or equity shareholders will get the dividends only after the payment to the preference shareholders. The fourth difference is that during the time of winding up, preference shares holders have the right to return of capital before equity shareholders. But the equity shareholders will get their return of capital only after paying the return of capital to the shareholders, or they will get after the payment of return of capital to the preference share, or they have a second position. And next difference is with respect to the voting power. In the case of the preference shareholders, they do not have the voting right, whereas the equity shareholders have voting right. In the case of the management, right to participate in the management, preference shareholders have the right, and whereas the equity shareholders have no right in equity shareholders have a right, whereas preference shareholders have no right in the management. These are the major differences between the equity shares and the preference shares. Next important share is the right shares. Right shares are the proportionate number of shares available to all existing shareholders of the company. There are proportionate number of shares available to all existing shareholders of the company, which can be bought at a given price for a fixed period of time. Here, proportionate number of shares distributed among the existing shareholders of the company are known as the right shareholders, and they are given at a fixed price and for a fixed time period. For example, a company announces right issue of 2:3 at rupees 100 per share, means that here the assumption is that current share price is 130. Another important feature of the right shareholder is that they can vote at a lower price, or they can bought the shares at a lower price than the current market prices, or these right shares are paid or sold at lower current market prices. And the right issue 2:3 at rupees 100 means if the current price is rupees 130, the right shares or the shares are paid to the existing shareholders at rupees 100, and they will issue two new shares for every 3 shares held by them at a rate of rupees 100 instead of 130. And another feature of right shares that it can be sold in open market also. If not subscribed at a prescribed time, it will be lapsed. And according to the Section 81 of the Companies Act, it requires that a public limited company, whenever it proposes to increase its subscribed capital after the expiry of 2 years from the date of its incorporation, or after the expiry of 1 year from the date of allotment of shares in that company made for the first time after its formation, whichever is earlier shall be required to offer those shares to the existing shareholders in proportion to the paid up capital as early as possible. Such shares are known as, or this right to shares are right shares are issued according to the section 81 of the Companies Act, and as per the Companies Act, section 18 of the Companies Act, it is said that the existing share must be, or the shares must be divided in proportion, divided among the existing shareholders in a proportion to the paid up capital. Then advantages of shares are that they get a special advantage. Value of the right is lower than the market prices, therefore they will get a special advantage. It enables existing shareholders to get an advantage, and their stakes in the company also increases. The advantages of the right shares are that controlled by existing control by the existing shareholders can be maintained by giving proportionate share to the existing shareholders. If a company issues right shares, there will be no cost on or no need of cost on advertisements or other cost related to the new issues. That means a company can reduce the cost of such issues if company issues the right shares. Then next important type is the bonus shares. Bonus shares means new shares given free of cost to all existing shareholders of the company in proportion to the shareholders. Here it is a bonus, that is, it is issued free of cost to all existing shareholders of the company in proportion to their holdings. For example, if a company announces bonus issue of 1:5, that is issuing one bonus shares for every 5 shares held by the shareholdings of the company. A company may issue bonus shares out of the free reserves accumulated out of the genuine profits, or these are issued out of the accumulated profits of the company. Therefore, it is usually issued at as free or at without any cost. And bonus shares are generally issued by the profits making companies by capitalizing the free reserves, and they have to satisfy certain conditions, or in order to issue bonus shares the company must have to fulfill certain conditions. They are: bonus issue should be authorized by the articles of associations of the company. Second one, shareholders must sanction in the general meetings on the recommendation of the board of the company, or they will get a sanction from the board of the company. They should, or it should be in connection or in tune with the SEBI guidelines. And the next condition is that if the company has taken any loan from other financial institutions, they must get permission from them. Then another condition is that it must be intimated to the stock exchange. Then only the bonus shares can be. These are the shares issued to the existing shareholders at free of cost, or these are like bonus. Then another one is the blue chip shares. Blue chip shares are the issued by large, well-established and financially sound companies, and it has operated for many years. This is one of the best rated shares. It has highest status, means these are issued by the financially sound companies that are operating for many years. It ensures high returns, high yield, marketability, liquidity, safety, etc. And it can be issued by the companies who have market capitalization in billions, who are the market leaders, who have strong asset position, who have high credit rating and who have stable earnings and stable dividend history or good history, reputation, large size, leader in stable returns, dividends, etc. These types of companies can issue blue chip shares, or these are issued by the reputed firms, and some of the blue chip companies in India are given here: Indian Tobacco Company, Hindustan Unilever, Reliance Industries, Tata Consultancy, ONGC, HDFC, Infosys, etc. are some of the examples of the blue chip companies in India. Then another type of capital market instrument is the golden share. The golden share is a nominal share which is able to outvote all other shares in certain specified circumstances, or this has special voting right over the other shareholders of the company. These are or these are the shares with special voting right, and these are issued to retain the power of the government after the privatization. These are issued in the case of strategic industries, and this golden shares are issued to get control over the industries by the government even after the privatization. They have a power to veto to and to any takeover. There is any shares by or any of the shareholding patterns. It is implemented through a clause in a company's articles of association, and this term arose in 1980s when British government retained golden shares in companies that privatized, and these approaches were later on taken over by many countries, European countries, as well as the Soviet Union. Then another type of capital instrument is the sweat equity. Sweat equity means equity shares which are issued by a company to its directors or employees at a discount or for consideration other than cash for providing their know-how or making available rights in the nature of intellectual property rights or value addition. These are paid to the directors or the employees for their reputed works to the companies, and they are issued at a discount or at a considerations. Second, sweat equity is a type of investment that measures the time and efforts put into a project by the directors or the employees. It is the ownership interest or increased value that results from the owner's hard work. In startups, set equity may be the biggest contribution of the founders who may not have. The set equities are paid to the shareholders who are providing hard work, or these are a sort of services to the company or for the services rendered by the shareholders of the company. These are the different types of instruments that are available in the capital market. Some of the instruments available in the capital market that we have discussed so far are equity shares, preference shares, and we have seen some of the different types of the preference shares, right shares, then bonus shares, blue chip shares, and equity shares, sweat equity shares. These are some of the important golden shares. These are some of the important instruments of the capital markets in India, or available capital market instruments.